Hey everyone, welcome back to Corporate Decoder. Today MYXXU just filed their 10Q report for the quarterly period ended the 31st of March 2026, and I'm seeing a very common SPAC story unfold. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing shows the quiet period before the IPO storm and reveals the basic building blocks of a SPAC about to hit the market. So here we have the latest 10Q filing from Maywood Acquisition Corp, or MYXXU as you'll see it on the market. This is essentially a look under the hood before they officially went public in a big way. It covers the first 3 months of 2026, right up until the 31st of March. Remember, a company like this, a SPAC or a special purpose acquisition company, it is like a company with no business yet. It is formed with the sole purpose of raising money through an IPO to then go out and find another real operating business to buy. So these early filings for a SPAC are all about the setup, not about a running business. Let's dive into the balance sheet. This gives us a snapshot of what the company owns and owes at a specific point in time. As of the 31st of March 2026, they had just $852 in cash. That might sound incredibly low, and it is, but this is completely normal for a SPAC before its IPO. All the real money is about to come in. They had $168,141 in deferred offering costs. Think of these as expenses they've already paid for things like lawyers and accountants to get ready for their big stock market debut. It's money spent in anticipation of raising much, much more. On the other side, their total liabilities were $165,572. A chunk of that, $139,000, was a promissory note, meaning a loan from a related party. This is common too, where the founders or sponsors of the SPAC lend money to the company to cover early expenses before the IPO cash comes in. Then we look at the equity. They had 0 preferred shares and 0 Class A ordinary shares outstanding at this specific moment. This is because Class A shares are what the public will buy in the IPO. However, they did have 4,040,541 Class B ordinary shares issued and outstanding. These are typically held by the founders or sponsors of the SPAC. They usually come with extra voting rights or other advantages and often convert into Class A shares after the SPAC merges with a target company, and notably an accumulated deficit of $21,579. This is just the running total of expenses minus any income, which in this pre-IPO phase is just a loss because there are no operations. Now let's look at the statement of operations, which shows their income and expenses for a period. For the 3 months ending the 31st of March 2026, their total expenses were just $4,780. This again is mostly formation and operating costs. They had a tiny bit of interest income, $194, and a net loss of $4,586. This is all expected for a company that has not yet started its main business operations. The weighted average shares outstanding was around 3.5 million. This reflects the Class B shares that were already issued, and the net loss per common share was basically 0 or $0.00, which is also typical when you have such a small number of outstanding shares and no revenue. This table shows how the equity section of the balance sheet changed over time. It starts at inception on the 3rd of June 2025 with 0 equity because the company was just formed. Then you see the issuance of those Class B ordinary shares to Stone Bay LLC, bringing in a small amount of capital, $24,596 in additional paid-in capital, and that resulted in total stockholder equity of $8,007 by the end of 2025. By the 31st of March 2026, after accounting for the net loss during the quarter, their total stockholder equity was down to $3,421. Still very small, all part of the pre-IPO setup. The statement of cash flows tells us where the money came from and where it went. The net loss was $4,586, and that translated to net cash used in operating activities of $4,586. No surprises here, they weren't earning any money from operations. Under financing activities, they received $50,000 from that promissory note, likely from the sponsors, but they also spent $53,950 on deferred offering costs. Overall, their cash decreased by $8,536 during the quarter. And that is how they ended up with that tiny $852 cash balance on the 31st of March. Now, let's look at some of the notes to these financial statements. These notes provide crucial details that the financial tables alone don't show. This note confirms the company is a blank check company, incorporated in the Cayman Islands in June 2025. Its goal is to find a business to combine with. This is a key point. As of the 31st of March 2026, they hadn't even even started serious talks with a potential company to acquire. This indicates they were still very much in the early stages of their IPO process. This is super important context. This filing is from before the IPO. The real action, the big money coming in, happened just days after the 31st of March, 2026. The IPO closed on the 15th of April, 2026. This section talks about the trust account. When a SPAC goes public, most of the money raised from investors doesn't go into the company's operating accounts. Instead, it is put into a special trust account. In this case, $100 million was to be placed in a trust account at $10 per unit. This money is held securely until the SPAC either finds a business to buy or it has to return the money to investors. This refers to the rights of shareholders. If you buy shares in the IPO, you usually have the option to redeem your shares, meaning get your money back. If you don't like the business combination the SPAC eventually chooses. This is a crucial protection for early investors. Here we get into the accounting rules they're following right before going public. Under going concern consideration, they state that as of the 31st of March 2026, they had very little cash and working capital. But they explain that after the IPO, which happened in April, they would have enough money to operate for at least a year. This is a standard way for SPACs to show they can continue operating after they raise funds. This policy clarifies how they treat the costs associated with going public. These costs are initially put aside or deferred, and then are typically deducted from the capital raised when the IPO actually happens. This explains how shares that can be redeemed are treated. Because of redemption rights, these shares are classified as temporary equity, meaning they are not considered permanent ownership in the company. This is a key accounting treatment for SPACs. This note details the planned IPO. They plan to sell 10 million units at $10 each, aiming to raise $100 million. Each unit was made up of one class of share, one right, and one warrant. The rights and warrants are essentially options that give holders more shares or the chance to buy more shares later, often tied to the success of the business combination. This is about a private sale of units that happens at the same time as the IPO, usually to large investors or the SPAC sponsors. Here, one of the sponsors, Westpike LLC, agreed to buy 140,000 units at the same $10 price, totaling $1.4 million. These private placement units often have restrictions like not being able to sell them for a certain period. This is where we see how the company interacted with its founders or sponsors before the IPO. It details the founder shares like the Class B ordinary shares we saw earlier. Stone Bay LLC paid a very small amount, $25,000, for a large block of these shares, which typically comes with greater voting power and allows founders to benefit more if the SPAC is successful. This confirms the promissory note we saw on the balance sheet. Stone Bay LLC loaned up to $300,000 to cover offering costs. As of the 31st of March, $139,000 were outstanding. This note covers agreements and potential future obligations. This mentions the engagement letter with the underwriter D. Borrell Capital LLC. It outlines fees like a $500,000 cash underwriting fee and the issuance of representative shares, which is an additional form of compensation for the underwriter. This section expands on the details of the different types of shares. It reiterates the details on Class B ordinary shares, their conversion into Class A shares, and the fact that they have super voting rights before a business combination. It explains the rights included in the units. These give the holder the right to receive a fraction of a Class A share upon a business combination. If no business combination happens, these rights expire worthless. And the warrants. These are like options to buy Class A shares at a set price, $11.5 in this case. They become exercisable after the business combination. The note clarifies they are equity instruments and not liabilities. This is a very important section for understanding what happened after the reporting period. It confirms the successful initial public offering on the 15th of April, 2026, raising $100 million, and the concurrent private placement raising another $1.4 million. This details the significant costs associated with the IPO, about $4.3 million. This includes underwriting fees, the value of those representative shares given to the underwriter, and other legal and filing fees. A large portion of the money raised will go towards these costs. It also mentions that after the 31st of March, the promissory note was partially settled through a non-cash arrangement, and some of it was still outstanding. This section is management's explanation of the financials. They reiterate that they are a blank check company, formed to find a business combination. They confirm no operations have begun as of the 31st of March 2026. All activities were related to the IPO preparation. They highlight the IPO success in April, raising $100 million. They have no operating revenues yet and expect to earn interest income from funds held in the trust account. The net loss of $45.86 for the quarter was primarily due to formation and operating costs. They explained their pre-IPO liquidity was minimal, relying on sponsor loans and IPO proceeds. After the IPO, they had the $100 million in the trust account plus funds outside the trust for expenses. This is the typical path for any SPAC. They conclude that after the IPO, there is no substantial doubt about their ability to continue as a going concern, which is standard language for companies that have just raised significant capital. This one is interesting. It discusses their disclosure controls and procedures. Management stated that their disclosure controls and procedures designed to ensure accurate and timely financial reporting were not effective as of the 31st of March 2026. This is a common finding for companies in their very early stages, especially SPACs, where the focus is on the IPO rather than robust internal controls. However, it is something to watch. This describes the shares issued before the IPO. This details the genesis of the founder shares, showing how the sponsors got their stake for a very low price before the public offering. This lists the accompanying documents. Included are certifications from the CEO and CFO attesting to the accuracy of the financial statements. So, what's the story here? MYXXU, like many SPACs, presents a picture of a company in meticulous preparation mode before its big entrance onto the public market. The financials show minimal activity, mainly tied to organizational costs and getting ready for the IPO. The real financial picture, the $100 million raised, the trust account, and the subsequent investor activity, all happened in April, just after this reporting period. The key takeaway is that this filing captures the company before the IPO. The lack of operations and the reliance on sponsor funding are standard. The mention of disclosure controls and procedures were not effective is a minor flag, but common for pre-IPO entities. What matters more are the subsequent events that show the IPO was completed. My biggest concern for any SPAC after its IPO is always the same. Can management actually find a good company to buy and successfully integrate it? The financial numbers in this report are just the very beginning of that journey. We will need to see future filings to understand how they are performing after a business combination is completed. That is my take. Stay decoded. If you want the broker and charting tools I use, they are linked in the description. Maywood Acquisition Corp. To buy. 2.3 Wu.